Welcome to Managerial Accounting, Chapter 1, Introduction to Managerial Accounting. Now I'm going to walk through the PowerPoint slides, which are produced by the publisher. I'm going to add my own comments as I'm going through. You do not need to watch this video. If you choose, you can just read the PowerPoints on your own. You can listen to this recording instead of actually watching the recording, or you can go to the textbook and you can read the chapter from the textbook. I don't care which one you do, but I will not be covering this information in class. So you have to decide how you're going to cover this off before the class starts. Because again, I'm not covering this during class. Class time is focused on solving problems. And if you walk into class without having done one of those things, read the chapter, read the PowerPoint slides, watch this video, listen to this video, one of those things have got to be done, because if you walk into class without doing any of them, I'm going to tell you, you're going to be confused. So this is on you, and it shouldn't take very long. You don't have to take notes unless you want to. This video is always going to be there. The PowerPoint is going to be posted. The textbook is always there. So your choice, but one of them has to be done before you walk into class. Now, you can see there's a lot of learning objectives for this chapter. So I'm going to give you the style of problems that you might see in the midterm exam or on the final exam. This will be tested on both of those. So remember, 8 learning objectives. Let's get started. Learning objective 1, identify managers' 4 primary responsibilities, but we can't do that unless we know what managerial accounting is. So what is managerial accounting? Unlike financial accounting, which is all about reporting to external users because they don't work for the company and they don't know anything, so we've got to tell them everything. In managerial accounting, we're going to the internal management and we're giving them information that they need to run the company, to do a good job and meet their organizational goals. So we're providing information internally rather than externally. And whatever they need, we're going to provide them. We don't have like financial statements or set things. No. If they need something, we're going to provide it no matter what form they ask for it in. Now, there are 4 primary responsibilities of managers. If we don't understand what managers are doing, then we can't provide the necessary information to them. So we got decision-making, planning, directing, controlling, and then feedback. Notice feedback is going equally through all of them. So controlling gives us information, which will then affect our planning and our directing. Our directing is dependent on our planning, right? And our controlling is dependent on our planning and directing. Keep in mind that this is like a feedback loop. And we don't plan once and then run the business for 20 years. We are constantly planning, constantly directing, constantly getting feedback, which then changes what we're planning for the future. This is not a one-time deal. We're doing it constantly as managers in an organization. So what is planning? It's 2 things. First, we're going to set goals and objectives for the whole company. So we're going to start a restaurant, and we want the restaurant to provide the finest fresh food that is, obtained locally. So that's our overall objective and goal in this organization. And so once we have that, goal or objective, then we can move on to determining exactly how are we going to achieve those goals. So we're going to develop relationships with local suppliers. We're going to advertise to the individuals who actually want to eat fresh, locally produced food. We're going to take all of our plans and we're going to make it into individual tasks. We're going to provide timelines for those tasks, and we're going to brainstorm how much it's going to cost and whether it's even feasible to do any of this. So keep in mind overall planning, and then all our plans plus timelines plus costs to achieve those goals. Directing is then hiring all those individuals who are going to work in the company. They're going to implement the plans, and by doing so, they're going to achieve the organization's overall goals in the day-to-day operations. Keep in mind, we're still going to have planning constantly, and every time we plan something or change something, we're going to direct everybody, all the managers and all the employees, to implement those plans and give us day-to-day information. So examples would be, we want to know for every single day which items on the menu are giving us the highest sales, right? And then we're going to use that information to determine future menu choices and future marketing strategies. Then we have controlling. And controlling is where we say, okay, we had a plan and here's how we implemented it. And did it work? The actual is going to be compared to the plan, and we're going to decide, did it actually work? So examples would be, we had estimates of costs, and now we're going to take those estimates, our budgets, and we're going to compare it to actuals. And then if it didn't quite work out the way we thought it was going to, we're going to make changes. Or if one item worked out fantastically and two others didn't, we're going to, push this one item, and then we're going to drop the other two from our menu. Keep in mind, we're trying to figure out if our actual results matched our plan. And if they did, fantastic. If they didn't, we're going to start tweaking with that feedback, and that's going to feed back into the plan. We're going to change the plan, then we're going to direct, then we're going to control, etc. Decision making, of course, encompasses all three of those things. Management is continually making decisions. They're constantly planning and directing, and then they're using controlling to see if those decisions actually worked out. So things like the location of the new restaurant. Are we going to take on an old restaurant and refurbish it? What kind of staff are we going to hire? How are we going to train these staff? What are going to be the prices of each of the meals? Which menu items are going to be there? So let's see how much you understood. We're going to check the functions of management. Here's the first question. Identifying alternative courses of action and choosing among them. Planning, decision-making, directing, controlling. This is decision-making. So this is making a decision to go between one and another. And the way you can tell decision-making, usually it talks about alternatives. We've got, two locations we can choose from, and we have to choose between these two locations. That's alternatives. So generally when you see something about alternatives, it's decision-making. Running the company on a day-to-day basis. Well, you know what this is because they said day-to-day. This is all about directing. Determine whether the company's units are operating according to plan. Well, I'm checking the actual against the plan. That's going to be controlling. Setting goals and objectives for the company and determining strategies to achieve them. Well, I'm setting goals and objectives. That's going to be planning. So you can see this is the type of question you're going to get on the midterm and final exam. Make sure you understand the difference between planning, directing, controlling, and overall decision making, because if you don't, you're not going to be able to answer those multiple choice questions. Let's move on to objective 2, distinguish financial accounting from managerial accounting. So we can look at this in a chart form, managerial versus financial accounting. The user, the time, the period, the regulations, the audits, the focus, and the scope. Again, remember, you're going to need to know this in order to do a multiple choice question. I might give you, which one of the following is financial accounting, describes financial accounting. And I'm going to give you 5 choices, and you're going to have to decide which of those choices actually are financial accounting. So for the user, financial accounting focuses on the outside, the external user. Managerial, internal. When we look at financial accounting, it's always past information. We publish the financial statements for the past year. With managerial accounting, what we're trying to do is focus on what might happen in the future. So yeah, we're going to use past information, but we're going to use that past information to predict the future. The period for financial reporting is a fiscal year. But for managerial, it could be anything. It could be, what do we do every single Monday? For regulations, financial reporting, we need to use GAAP, Generally Accepted Accounting Principle, IFRS, International Financial Reporting Standards, tax law, or OSC, which is the Ontario Securities Commission. Managerial, we don't have any regulations. We're using whatever information we have to try and predict the future, which we know we really can't predict, but we can guess. So there's no regulations that we have to follow for managerial accounting. Audits are mandatory for public corporations in Canada. However, they are not mandatory for managerial. There is no mandatory audit. We don't have to audit any of the information that we provide to managers. There's just no audits. The focus for financial reporting is we want accurate and verifiable information. Why? Because the public who buys our shares want to know accurately what's happening in the company in the last year. They want to be able to verify that information. But for managerial accounting, what we're looking at is how relevant is the information for decision making? How timely is the information that I'm getting as a manager so that I can make decisions quickly? So we're not looking for accuracy because there's no accuracy in predicting the future. The scope for managerial accounting is segmented. So I might look at one restaurant location. I might look at one dish in that restaurant or one drink in that restaurant. Whereas for financial reporting, it's all about consolidating all of the information from the whole company into one financial statement. So keep in mind, these things you need to understand because I'm going to make up questions and they're going to show up on the midterm and the final exam. So let's do a quick check. Are the following statements more descriptive of managerial accounting or financial accounting information? A. Describe historical transactions with external parties. You saw historical and external. It's going to be financial accounting. Is not required by any authoritative body, such as the Provincial Securities Commission. Well, you know if it's not required, it's going to be managerial accounting. Reports on the company's subunits, such as products, geographical areas, or departments. Not consolidated, managerial accounting. Is intended to be used by creditors and investors. Those are external users. This is going to be financial accounting. Is formatted in accordance with ASPE or IFRS. Well, there's no regulations in managerial accounting. This has got to be financial accounting. Utilized by readers to support decision making. Well, external users use the financial statements to support their decisions. Should I buy the stock? Should I not buy the stock? Should I lend to this company? Should I not lend to this company? But you think that internal users are using whatever information is provided under managerial accounting to make decisions. So in this case, it is both. So keep in mind, this is the type of question you might get. Slightly different format, most likely multiple choice. And I'm going to give you a bunch of statements and say, which of the following statements are managerial accounting? Or which of the following statements apply to financial accounting? Learning objective 3. Describe organizational structure and the roles and skills required of management accountants within the organization. So here is a sample organizational structure. You can see that there's a board of directors. The audit committee reports to the board of directors. The chief executive officer reports to the board of directors. Under the chief executive officers, there's the chief operating officer, so the COO, the chief financial officer, the CFO, and then there's going to be other individuals below them. So under the COO is the vice president, under the CFO is the treasurer and the controller. The internal auditors report directly to the audit committee. The external auditors are going to report to the audit committee. So this is an example. It's not always this way, but it definitely is a good example of how a company can be structured. Now keep in mind that managerial accountants' roles have changed. They could have senior roles, notice managers, internal consultants, advisors, but they're in every part of the organization and pretty well every industry. I can't think of an industry that does not hire managerial accountants. Technology has really changed the role of a managerial accountant. Yes, we are ensuring that we have accurate financial records because we're going to use that information to predict the future, but we're more interpreting the accounting data, analyzing it, and supporting managers' decision-making by doing that analysis. Managerial accountants have to have quite a few skills. They've got to lead a team. They have to be able to analyze the information that's coming in. They have to be able to make decisions and solve problems. They have to be able to communicate with individuals who aren't accountants in a way that allows those individuals to understand what we're talking about. We have to have accounting knowledge so that we report everything appropriately, but we also have to have business knowledge because otherwise we can't advise our managers. And finally, we have to have professionalism and ethical standards. So let's do a quick check. The following is a list of job duties or descriptions. Determine if it is the responsibility of the treasurer, the controller, or the internal auditor. Perform cash counts at branch office. In this case, they're just counting money, and that is the controller. Prepare journal entries for month-end closing. This happens at every month end, and it is putting the information into the accounting system, so that is the controller. Issue company stock. Well, this is a much higher up activity, and so that is the treasurer. Ensure that the company's internal controls are functioning properly. Well, they're actually checking if the company is doing what they're supposed to be doing with regards to their controls that are in place to, make sure the assets are safe, that kind of thing. So this is going to be the auditor because they're going to audit the controls to see if they're working properly. Create an analysis about whether to lease or buy a delivery truck. Well, in this case, we're really deciding, which way are we going to go? And so that's the treasurer. Calculate the cost of a product. This is something we're going to do every day. This is going to be the controller. Issue company bonds. This is higher up. It's going to be the treasurer. So keep in mind the type of questions you're going to get on exams. Let's move on to Objective 4. Describe the role of CPA Canada and apply its guidelines for ethical behavior. If you have a professional accounting designation in Canada, you're talking about being a CPA, a Chartered Public Accountant. We no longer have CMA, CA, and CGA. We are simply one group, and it's all CPA, Chartered Public Accountant. We have very strict ethical guidelines. And what that means is we are going to do the right thing. No matter what pressure is on us, we're going to do the right thing. We're going to follow the rules and regulations, whatever they happen to be, and we're going to follow the spirit of the law. So it's not like, there's not a specific rule here that says I can't do this, so I'm going to do it. No. If we look at whatever we want to do and we say someone can be harmed by this, then we're not going to do it. And we do have specific rules under generally accepted accounting principles, international financial reporting standards, tax law, and the Ontario Securities Commission, rules, regulations, laws, all the rest of it. But keep in mind, it's not just following the rule to the letter. If we say to ourselves, hey, if I told everybody in the public that this is what I did, and some of them would be upset with me, then that's not ethical. Keep in mind that the rules support the stability of the country. If we can't trust the financial statements of a company, then our whole system of buying and selling stock is going to collapse. So if we're not ethical, we have some severe consequences. And we only need to look at some of the companies that were not ethical and see how badly it impacted individuals who had bought the stock and trust in the whole accounting system. Yeah. We need to make sure we act ethically because literally the stability of our financial markets are dependent on that. So examples of unethical behavior, and this is like a very short list because there's so many examples of unethical behavior. So allowing reimbursement of false expense reports. We have a manager who submits expense reports, they're false, we're colluding together, and I accept those false expense reports without the required backing, like receipts, and I sign off on it and send them a check. That's a problem. I manipulate income. So I have some deferred revenue and I put it on my income statement as earned revenue. So I'm manipulating the income statement. And as a consequence, my net income is higher, my retained earnings is higher. Yeah, no. Performing tasks not qualified to perform. So I'm doing the tax return and I have no background in tax. And breaking confidentiality requirements. Believe it or not, accountants are not allowed to work for a company and go home and complain about the company to their significant other or their family. Oh my goodness, I work for this company and they're so stupid, they're doing this and they're doing that and they shouldn't be. No, we're not allowed to say that. The only person you can talk to is your dog. That's it. You don't break confidentiality. And everything you do in the company is confidential. So our ethical guidelines is professional behavior. We're not going to do anything that puts the reputation of CPAs in a bad light. We're going to have integrity and due care. So integrity means we're always going to think of other parties before we think of ourselves. And due care is we're going to take care when we're producing information to make sure it's correct. Objectivity means we're not going to look at self-interest. We're going to be objective about the information that we provide. So let's say I have shares in a company and I'm providing the financial statements for the company. I'm no longer objective because I have shares in the company. And so I have an interest in keeping that share price really high. And so I'm manipulating the financial information because I've lost my objectivity. Professional competence means that I am going to ensure that I am trained in whatever I'm doing. If I'm not trained in taxes, I'm not going to do taxes. And finally, I am going to ensure that all the information I have about the company is going to be confidential. I am not going to talk about this company or anything they're doing to anybody else. So there are in Exhibits 1-5, there are guidelines for ethical behavior. Please make sure you pause the video or you go to the textbook and read through these. Now, what are the steps to resolve an ethical dilemma? Follow the company's policy. If the company says you realize something is unethical and we have, a 1-800 number where you can give this information anonymously, that's what you're going to do. Whatever the company has a policy about unethical behavior, you're going to follow it. If it's not resolved, then you're going to speak to your immediate supervisor as long as they're not involved. Discuss it with somebody who's objective and consult an attorney because you need to understand your legal obligation and your rights. Not all unethical behavior is illegal, but an illegal behavior is always unethical. So it is unethical for me to own shares in the company when I produce their financial statements. That's unethical, but it's not illegal. Unethical because I'm really required to be objective, and I'm not objective, but it's not illegal for me to do that. So there's a gray area here, right? You got to think, if everybody knew I was doing this, how would they feel about it? And if you think to yourself, well, they'd feel really bad. They wouldn't like that this is happening. That's unethical. Might not be illegal, but it is unethical. And of course, anything that is illegal is definitely unethical. So let's look at the ethical guidelines. Which ethical standard is described? Communicate information fairly and objectively. So fairly means competence, and objectively means, of course, objectivity. Refrain from using confidential information for unethical or illegal advantage. So what they're talking about is things like insider trading. So this has to do with confidentiality. Inform all relevant parties regarding the appropriate use of confidential information. Again, confidential, this is confidentiality. Monitor subordinates' activities to ensure compliance. Well, in this case, I'm looking at integrity and due care. Mitigate actual conflicts of interest. Well, we're going back to integrity and competence. Regularly communicate with business associates to avoid apparent conflict of interest. Advise all parties of any potential conflicts. So we're back to integrity, right? Acting in the best interest of everyone else, and also competence. Maintain an appropriate level of professional expertise by continually developing knowledge and skills. In this case, competence. Okay, so keep in mind, you have to understand the ethical guidelines. Let's move on to Objective 5. Discuss and analyze the implications of regulatory and business trends. We have to keep in mind that the business world is continually changing. I mean, we know that right now with regards to AI. What is in place to help us navigate this constantly changing world? So in the United States, we have the Sarbanes-Oxley Act of 2002. Now, this is in the United States, but we do have something similar in Canada. So what is this act? It is a U.S. federal law that was created to protect investors by improving the reliability and the accuracy of company disclosures. So the information that companies provide to external users. And the reason it was created was because of some major accounting scandals like Enron and WorldCom. There was a decrease in public confidence in the financial markets because Enron and WorldCom, they did some stuff that they should never have done. They weren't following the rules. And so because confidence in financial markets declined because people lost confidence in financial information, the financial reports, this act was implemented in 2002, and the act is new standards for things like corporate governance, internal controls, and financial reporting. And they now hold corporate executives and the public accounting firms that are auditing the companies accountable. So this was a really important act to help protect the users of financial information. We also have International Financial Reporting Standards, IFRS, and those standards are principles rather than a whole bunch of rules. They're principles that are supposed to guide everything we do in business. And as the world is changing, we go back to these principles to ensure that we're following them. We also have Extensible Business Reporting Language, XBRL. So what is XBRL? It's computer software language that uses XML to basically standardize the way financial information is communicated. It allows organizations to really be efficient when they're preparing and sharing and analyzing things like financial reports, financial statements, and any other business information. One of the business issues is that our economy is constantly shifting. So for instance, the tariffs are put in place and everything shifts in our economy. So one of the business issues that happens is the fact that the economy is constantly shifting between, expanding and contracting and all that kind of thing, and that creates business issues. We also have globalization. So I'm not going to create something here in Canada that is better produced in another country because they have the raw materials. And finally, sustainability. We want to be sustainable, which means that we are not using resources that can't be renewed. So for instance, I am not going to use a plastic. I'm going to use paper because I can plant trees and create more paper, but I can't create more plastic, which is created, of course, from a non-renewable resource, which is petroleum. We're going to talk about time-based competition. What is that? Well, we have a lot of competition right now, way more than we did in the past. 100 years ago, there might have been one company producing a good, but now we can have 40 companies producing a good. So we're competing with each other. These organizations are competing with each other. And time-based competition is really, really important because we want information in a shorter period of time so we can make decisions about things like buying and selling either company stock or even, the suppliers that we're using, buying our supplies. Integrated reporting is where we have very concise and integrated communication with our external users, our suppliers, our customers. This information can be used to decide on the strategy in the company, how the company is going to be governed, what the performance of the company is, what the prospects are that can create value for our customers or our shareholders, that kind of thing. And what we're doing here is we're looking at value creation, not just financial information, but we're looking at what activities in our company create value for our shareholders or our customers. We also want advanced information systems. So for instance, enterprise resource planning, an ERP system. Now an ERP system is basically management software, and it really integrates and streamlines a whole bunch of business processes. It's like a central place where it has information about finance and human resources and manufacturing and what suppliers we use and what sales we're making into which companies and how do we procure our raw materials. So it really provides a unified view of the organization, and it's a single resource. So having that central resource allows us to provide quicker information. We also have web-enabled business, and this is really important for supply chain management. So what is supply chain management, or SCM? It's basically overseeing the entire flow of goods and services, right from raw materials to the end consumer. And we're talking sourcing, production, logistics, distribution, everything. And it allows it to be efficient and less costly. So these two are tools, advanced information systems and web-enabled businesses, to allow us to compete quicker. All right, that's it for Objective 5. Moving on to Objective 6, describe a lean production system. So what are the characteristics of a lean production system? So first, we look at production in self-contained cells. So what does that mean? We have areas, for instance, in a factory that do specific tasks for usually a specific product or a family of products, and they do it in a continuous flow. That probably doesn't help you, but let's imagine we're producing a car. And so what's going to happen is I'll have a stamping area, and that will bring in the raw sheet material, and they will stamp out the metal parts of the car. And that's all they do continuously. They are constantly stamping out fenders aren't made from metal often anymore. They're made from plastic, but it might be an area of the factory that's producing all of the bumpers, and the bumpers are made out of plastic. So there's this continuous process where all they do is produce bumpers and they do nothing else. That cell is like a mini production line. It's got everything it needs, like machinery and the workers and the materials, to streamline the production, and it really reduces material handling. And it reduces lead time. It doesn't take very long to produce one bumper because that's all we're doing, producing bumpers and nothing else. So that's what self-contained cells are. They have broader employee roles. So employees don't just do one thing. They're going to be involved in a few things, most likely in that cell, but a few things in that cell. And they're also encouraged to continually improve the process. Things are produced in small batches just in time for production. So we're going back to that, part of the factory that produces those bumpers. They're only going to produce bumpers for cars that are already on the conveyor belt being produced. They're not going to stockpile anything. They're going to produce just in time to put on the car. And they're going to have setup times for the machinery as short as possible. They're producing only one bumper for one car. So setup time is going to be at the beginning of the day, and then they're just going to run continuously. Or it's going to be at the beginning of the month, and they're just going to run continuously. And they're going to try and reduce the period of time it takes to finish a product. So shorten the cycle time. So, a car rolls off a conveyor belt in a car manufacturing company about every minute and a half. So I want that manufacturing time to be as short as possible. And they're going to emphasize quality. They don't want to rework any products. Those individual cells are going to make sure that those products that they produce, or the item that they produce, has the highest quality possible. So to give an example, if we're looking at a traditional system, and you can see that traditional system on the left-hand side, we buy materials from suppliers, we stockpile them, not because we need them, we stockpile them, and then they go into production, and then we stockpile that, and then we go to the customers. No, I want to have a customer order. I'm only going to produce the car once I receive an order from the customer. I'm going to get the materials from the suppliers only for the orders that I already have, right? And then I'm going to produce it right away, and it's going to be sold to the customer immediately. I am not stockpiling my cars. I am only producing cars because customers have already ordered those cars. I am only ordering from the suppliers for the cars that are already on order, right? I'm only going to produce the cars that I need for the sales that I already made. Now let's talk about total quality management. And this is where the whole goal is to provide customers with excellent products or services. So we've got high goals with regards to quality, and we're continuously improving the quality of our products. And I'm going to be part of the International Organization for Standardization. So what is that? It's a worldwide federation of national standard bodies from more than 160 countries. So one from each member country. It's non-governmental. It was established in like 1947 or something like that. You don't have to remember that. It's based in Geneva. And the focus of it is to bring up all these global experts together to agree on the best way of doing things. So if I want top quality management, I'm going to be part of the ISO. So that's it for Learning Objective 6. Moving on to Learning Objective 7. Describe and use the costs of quality framework. So what are the costs of quality? There are 4 different quality costs. So one is prevention costs. I want to prevent costs from happening. So how do I do that? Well, one of the ways is, for instance, being sure I train my employees, that all of my suppliers have been vetted to be excellent suppliers. I'm going to use the best materials possible. I'm not going to use substandard materials and there's a whole bunch of breakage. No, I'm going to use really good materials. Next is preventative maintenance. I'm going to maintain all the machinery in the factory. I'm going to have the oil changed and I'm going to have it checked out on a regular basis so it never breaks down. I want to buy better equipment so that it lasts longer. And I want to redesign or re-engineer my product or my process to make sure it is as efficient as possible. So these are all going to cost me money, but they're going to reduce costs down the line. Then I have appraisal costs. So this is things like I'm going to inspect all the material that comes into the warehouse. I'm going to inspect all the lines that are working to produce the car. I'm going to inspect the final car when it rolls off the production line, right? I'm going to test the products on a regular basis to make sure they work as described. And I am going to incur costs for inspection equipment. Now, internal failure costs. These are costs that happen because our preventative measures did not work. So for instance, we have downtime because we haven't properly trained our employees. We need to rework products because we didn't buy good enough material. So we're taking them from the end of the production process and we're putting them back at some point in the production process so we can rework the product. We have huge amounts of scrap. So that means we didn't buy the best material and the material is breaking as we're producing the product. We have an inspection process, but they're rejecting a lot of the products because they don't meet the required standards. And then we've got these rejected products and we have to dispose of them because that costs money. And then finally, we're not doing maintenance on our equipment, so our machinery is breaking down, and every time it breaks down, we can't produce anything. Internal failure costs are because the preventative measures don't work. Then we have external failure costs. So these are outside of the company. So we lose customers because we don't have the quality product that we're supposed to do. So now our preventative measures are not working. And by the way, our appraisal is not working because the inspection is allowing products to go through that are not, perfect products. We have warranty costs because things keep breaking down because we're not producing it on high enough quality. We have service costs because customers are coming back to us. And so we've got a whole bunch of customer service people who are fielding complaints from customers or dealing with warranties for customers. We have sales returns because there's quality problems. And then we have product liability claims, the car crashes. And so our inspection didn't work and our prevention didn't work. And then finally, we have the cost of recalls. Our seatbelts didn't work. And now we've got to recall 40,000 products. So these are the types of costs that we have in excess of product costs, because often we look at product costs and say, okay, this is how much this product costs. No, we've got all these other costs that go into producing a quality product. And these costs can be pretty significant. So for instance, if you look at this is example 1-11 from the textbook. Preventative costs, employee training costs us $125,000, right? Appraisal costs, testing costing $175,000. Internal failure costs, we got a lot of rework, and we've got rejected units, right, which we have to dispose of. And then we have the external costs. We've got, a loss of our reputation, $1 million. This is an estimate, of course. Sales returns, this we know. And then warranty costs. And so you can see the cost of quality is $2,060,000, right? A huge percentage of that is the external failure costs. So keep in mind that these costs can be pretty significant. So let's check your understanding of the cost of quality. So we've got a company that makes electronic components. They classify each item as a preventative cost, appraisal cost, internal failure cost, or external failure costs. A, costs of electronic components returned by customer. Well, we know that this is an external failure. Costs incurred by customer representatives traveling to customer sites to repair defective products. This is also an external failure. Lost profit from lost sales due to reputation for less than perfect products. We got external failure again. Cost of inspecting components in their production process. They're inspecting before they send them out to the customer. This is an appraisal cost. Salaries of engineers who are designing components to withstand electrical overloads. I'm preventing problems. Preventative costs. Cost of reworking defective components after discovery by company inspectors. So the inspector discovers something and we bring it back to the production line. This is an internal cost. So again, the type of question you're going to get, I'm going to give you a bunch of examples and I'm going to say, which one is it? And you have to be able to choose. Learning objective 8, the last one, describe foundational concepts in data analytics. What is data analytics? You probably know this, but we're going to go through it anyway. It really is collecting, summarizing, analyzing, interpreting, and transforming raw data into information that is relevant for decision making. Because if it's relevant for decision making, then we can make it actionable. We can take the information and say, okay, what action are we going to do moving forward to help the company meet its goals? So that's data analytics. What's new in data analytics? Basically, the volume of information available, and then the speed at which it is coming at us, and how accessible that information is to us, and then the different variety of data that is available to us. So that's new. Also new is the many tools that are available and continually changing, and new ones coming out, to collect and analyze data. What is the benefit of doing really excellent data analytics? Well, we're actually using data to support decision making. We're not guessing, we know. It's quicker with technology and quicker because of the speed of the information coming at us. We're becoming more efficient at gathering and actually using data to make decisions. And it's really helping us to adapt to all the changes that are happening in the economy, in the field, in the industry that we are in. And really, data analytics should drive innovation. As we learn more about what's happening in the past, we can use that information to innovate for the future. So what is the data analytics process? So one, we have to identify an issue. We can't just, people are like, oh, data analytics. No, we have to have an issue. So why is this not selling? We need an issue before we can actually do data analytics. We're going to then collect all the data connected to this issue, because with so much information available, we got to narrow down to an issue and collect only the data that is relevant to that issue. Then we're going to utilize all the tools and technology that are available to us, and that's going to transform the data into information that is relevant for our decision making. We're going to then communicate that information to the decision makers, and those decision makers are going to act. They're going to choose a plan and they're going to implement that plan. And then we're going to go back to the beginning and we're going to identify the issue, collect data, etc., etc. It's a constant process. So data analytics are really important, but it's important to understand how to use data. We just don't have this idea, oh, we're going to take all the data that's connected to our company and analyze it. No, we have an issue and we're going to take all the data to try and solve that issue. So that's it. Let's do a quick check to see what you understood. Pause the video and try to answer these yourself. Which of the following is not one of the 4 primary responsibilities of management? Controlling, costing, directing, planning. And the answer, of course, is costing. I'm never going to ask you a question that is this basic. Which of the following is true about managerial accounting? IFRS and ASPE require managerial accounting. Internal decision makers use managerial accounting. Public accountants audit managerial accounting reports. Managerial accounting reports are usually prepared on an annual basis. So the only one that is correct is that internal decision makers use managerial accounting. IFRS and ASPE are not required for managerial accounting. Public accountants don't audit managerial accounting reports, and managerial accounting reports are not prepared on any specific annual basis or semi-annual basis. It's whenever it's needed. Which of the following is a characteristic of financial accounting information? A, emphasizes relevance. B, focuses on the future more than the past. C, provides detailed information about parts of the company, not just the company as a whole. And D, emphasizes reliability. And the answer is emphasizes reliability. Relevance is about managerial accounting. Focusing on the future, managerial accounting. Financial accounting focuses on the past. And detailed information about parts of the company, financial accounting is all about consolidation. What company position is in charge of raising the firm's capital, the money? A, Director of Internal Audit. B, Controller. C, COO. D, Treasurer. And the answer is Treasurer. Everyone else is responsible for different activities. Which of the following statements is true? The COO reports to the CFO. The Treasurer reports to the CEO. The Internal Audit Department reports to the Audit Committee. The Controller reports to the Internal Auditor. Answer C. The Internal Audit Department reports to the Audit Committee. Keep in mind, this is a very unlikely question for me to ask you because we don't know what the organization of each company is, and it can differ between organizations. So because this is fluid, it's probably not a question I'm going to ask you. A management accountant who refuses an expensive gift from a software salesperson meets the ethical standard of A, professional behavior, B, confidentiality, C, integrity and due care, D, professional competence. And the answer is C, integrity and due care, because there is no conflict of interest, right? You are not being personally impacted by this gift because you've refused it. You have integrity and you're taking due care to protect the client that you're actually working for. All right, that's it for Chapter 1, Introduction to Managerial Accounting. Remember, this content will be tested on the midterm and the final exam.